This is the essence of gold. It has protected people's wealth in many countries and many times throughout history, and it will do so again.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for July 8th through July 15th, 2024, while supplies last. First, we feature 2024 American Silver Eagles at just $5.95 over spot. Next, we have backdated gold 1/10-ounce Eagles at $39 over melt per coin. And finally, we're offering Dealer's Choice Constitutional Silver half dollars at $2.50 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're delighted to have a returning guest. Adrian Day is our returning guest on our channel, whom my son Elijah usually interviews, but I'm here at the Rural Symposium on Natural Resources Investing in Boca Raton, Florida. Today is Wednesday, July 10th, 2024. Adrian, thanks for coming back on Liberty and Finance.
Well, thank you very much for asking me. It's going to be good.
It's a pleasure, and you had a full calendar, and you were able to shoehorn us in there anyway, so thank you for that. Our viewers always welcome your visits.
Well, thank you.
And I was hoping maybe since your talk isn't until tomorrow at the show, we won't expect you to divulge the full details of it, but could you thematically at least tell our viewers what it is that has interested you so much that you're going to be talking about it tomorrow?
Right. Well, the first thing I'm looking at is, first of all, some of the things that are driving gold. And as you know, and I'm sure most of your listeners know, the most interesting thing to me is that we've got a gold prices moving up, and yet we've got outflows from ETFs, both in North America and in Europe. We're seeing steady outflows. Even throughout June, we're still continuing to see these outflows. The same phenomenon's happening with the gold stocks. Of course, the GDX is seeing outflows. Mutual funds are seeing outflows. So that's a puzzle. So I'm looking at that. We can discuss that if you want. The second thing is, the economy, particularly in the US, but the economy in general. And I think the economy in the US is in a far worse situation than the headlines suggest. I think we're moving towards a recession. Inflation is not under control. So there's a difference between reality and perception, or perception and reality. Headlines on most of the things, and the same goes for the stock market. So I look at that as well. You look at the stock market, the S&P continues to go up. The S&P is stronger, the US stock market, strongest stock market in the world this year, continue to go up. And yet 50% of the gain is a single stock, which, however great that company is not a healthy stock market. And we're getting more stocks with 52-week lows than we are with 52-week highs. I'm not a sort of market technician, but that is a bad sign when the market is moving to new highs, and yet individual stocks are making new lows. So the breadth in the market is very bad. So again, just as with inflation, just as with employment, just as with the economy in general, there's a difference between the headline, and then if you look under the hood or look under the bonnet, which is what we do in England.
That's right.
It's a little more nuanced at best, and a little more negative situation. So that's the second thing I'm looking at. And the third thing, which probably is of less interest to you, is the gold stocks, which are just stupidly cheap. Stupidly cheap.
Actually, that's of increasing interest to our viewers because we continue to have representatives from the hand-selected group of companies that Rick Greuel has brought to this symposium as guests on our channel. Yeah. And our subscribers are actually looking at if they want to invest in something that is based on something that is real, rather than on just some future derivative hope of something. How can they invest in companies that actually have something real under their boots? Right. So maybe we'll just touch on all four of those major themes. We just recently interviewed Alistair McLeod, former bank director, and he talked about this phenomenon of a rising gold price in the face of outflows, physical outflows from the major ETFs. One of the ways he told us we should consider looking at that, and it'd be interesting to bounce this off of you, is that rather than fixating on the gold price, see that as a secondary effect of perhaps a primary move of, for example, Chinese not only government but also private divestment of like U.S. dollars and U.S. treasuries, and that they're not going to go into the euro, and they're not going to go into the yen, and they're not going to go into Chinese real estate, which is yesterday's story. So they're looking for the gold is like kind of a last resort, as it often is in times of economic trouble.
And then we're allowed to buy crypto.
Right.
So
yeah. So that's one way of looking at it. That would actually, looking at that narrative would actually explain, you would, result of that, you would see a rising gold price perhaps, and you would possibly see outflows if there was this west to east movement of physical with repatriation. And then I know Andy Schechtman, whom we interview often on our channel from Miles Franklin, has talked about the BRICS Plus and their stated intention to come up with this unit currency for international settlement, partially based on gold, which can be held by each member country within their own borders, that sort of thing. So that would also explain perhaps at least it would correlate with a net outflow of physical gold towards those countries rather than staying in the So do you want to give us your perspective on both of those?
All of that is true. And the way I look at it is, if you look at the macroeconomic environment, just look at it now. Don't look under the hood and don't look ahead. Just look at it. You've got a strong dollar. You've got high interest rates. You've got relatively low, we can argue, but relatively low inflation. 3.5 is a lot more than 2, but it's not runaway inflation. So you've got low inflation, you've got a strong economy, apparently, and you've got a strong stock market. That's precisely the worst environment possible for gold and gold stocks. So the question is, why are these things going up? And as you mentioned, there's the national central banks around the world, led by China, but a lot of buying from different central banks. And you've got Chinese consumers buying gold. Those are the two largest, on the plus side, those are the two largest demand sources for gold buying. And neither of those, Chinese investors or central banks, are looking at the macroeconomic environment as a reason for buying gold. They're buying gold for much more fundamental reasons, some of which you've mentioned. And so it's not, to me, and yet the Western investor, particularly the smaller investor, is indeed looking at the macroeconomic environment. And he's saying, interest rates are high and inflation's low, I don't need gold. He's saying the stock market is strong and the Magnificent Seven are, well, they're Magnificent Four now, but anyway, they're magnificent. I don't need gold stocks. So on the surface, it seems sort of very peculiar, but we're seeing these outflows from the ETF, gold going up. And yet, to me, there is a rational explanation. It's not totally irrational. Now, again, if you look under the hood and if you look ahead, then I think, these things are going to change. They're not all going to change dramatically, or they're not all going to change immediately. But to me, the U.S. economy is definitely slowing, and that just adds pressure on the Fed as well as other central banks to lower rates. And as you know, many central banks around the world are already now, after raising rates, are now already on the rate cutting cycle, including Canada and the ECB, European Central Bank, as well as many smaller countries. So, the Fed is going to follow. Inflation, I don't think, is under control by any means. Let's put aside for now whether we believe the numbers or not, because I don't know anyone who thinks that their cost of living only went up 3.5% last year. But put that aside, it's an important factor, of course, but even notwithstanding that, you just had the oil price go from 72 or 70 to $80, basically, 71 to 78 or something, in the last sort of 6 weeks. That's all going to flow through. When the oil price goes up, that all throws through into the cost of every good in the store. Everything is transported, everything. And so that suggests that cost of goods in the store are going to go up. You look at last year's numbers for September, October, November, they were pretty low numbers. That means everything else being equal, the year-on-year comparison is going to be worse in the next 3 months than it was in the last 3 months. And then you have to look at specifics. One thing I look at is one particular anomaly would be healthcare, which is healthcare is I think is the second largest
line item
component
cost.
in the core CPE. Right, that's for people who don't eat and don't use any power. And after that, the most important factor is healthcare. According to Bureau of Labor Statistics, healthcare for U.S. people went down 27% last year. I can tell you right now, my insurance didn't go down 27%. I don't know about yours. And so somehow, I'm not saying they cheated. I'm just saying somehow they have to manipulate those numbers to bring it back into reality, because that's not real. So anyway, for various reasons, I think we're going to see the CPI numbers, at minimum, they're going to inch up. At minimum, they're going to be stubborn. We're not going to get down to 2%. And so anyway, slowing economy, lower rates, higher inflation, and now you have an environment that's actually positive for gold.
Mm.
So, and the market is forward-looking. As a contrarian, I'm a little bit, frustrated that people are continuing to sell gold. It's one thing if they're not rushing into it, but the ETFs are continuing to sell gold. Maybe you can tell me about your firm, but I know a lot of the coin dealers I talk to say they're getting just as many people calling to sell coins as they are to buy coins.
Well, there are a couple of factors I think there that we've seen. And you're right. The number of purchases have declined and the number of sellbacks have increased.
Yeah.
And many of those, and I would say most of those who call me as a broker and say that they need to sell back coins, it's not because there's some wonderful opportunity they're trying to take advantage of at this point. It's because their costs of their life has become more expensive, and they need the funds that they were hoping. And frankly, since gold and silver have moved up finally, significant in the last quarter, they think maybe now is the time when I should try to get some liquidity if I need liquidity for my life. And frankly, looking at metals as a offline savings account, that actually worked quite well for some. Those who were hoping things would have gone to the moon by now or whatever are disappointed. But those who put their liquidity into metals over the past 5 years, anytime, and now are liquidating because they need to for whatever purpose, it was an effective offline savings account.
Absolutely, and that's why anytime we get a market crash, people sell gold. So why are you selling gold? Well, that's exactly gold's purpose. It's a store of value, but is liquid, but you can use when you need it. But it's interesting you say, if I may, what you just said about because we're seeing that a little bit of that with our managed accounts, to be honest. When you have a person with a $300,000, $400,000 account who's not touched the account for 5 or 10 years, and he calls and wants a $10,000 withdrawal, I mean, that's a sign of stress.
Mm-hmm.
And let's just think about it. The economy is nowhere near as strong as people are saying. Credit card debt, used car loan debt, all sorts of debt outside of mortgages, all sorts of debt in the U.S. economy is at record highs. We can talk about 3.5% inflation, but even if you look at the government numbers, that compounds, right? So the government says that costs have gone up by 22% in the last 4 years. Well, if your income hasn't gone up by 22% in the last 4 years, you are falling behind. And so I think there's a lot of stress in this economy, frankly.
And you also mentioned in addition to the economic reality, but the terrible breadth of the stock market. So again, these headline statistics, and we've interviewed John Williams from shadowstats.com.
Oh.
He pulls the curtain back on a lot of these, what he calls headline statistics,
Yes.
and says, this is the number he said, you have to work really hard and suspend a lot of disbelief to come up with this number, because this is the number that you would come up with if you didn't change the rules and move the goalposts and do all this tap dancing.
Right.
But if you look at the stock market, it's another one of those stories. It's a headline number that's supposed to give people a sense of calm that they should just keep on contributing from their earnings and so on, and hopefully it'll recover and come back. And yet, having those of us who've lived long enough to live through stock market booms like the .com bubble and so on in the past, have seen that this narrowing of the leaders versus laggers is a very unhealthy sign.
It's very unhealthy.
And you end up with a few that are carrying the whole market. In fact, some few stocks together are more than half the value of the entire market. And like 40% of some of these markets are, in fact, zombie companies that can't even pay their obligations on their existing corporate debt, and which is about to get refinanced at higher rates.
Well, that's another point I make in the talk. Yes, it's higher for longer. Even if you don't raise rates, the longer you keep rates where they are, the more households and corporations, get dragged into the higher interest rate environment. So, the family that bought a used car 7 years ago, and they paid what, I don't know, LIBOR, it's not LIBOR anymore, but it's called SOFR. LIBOR plus 4 or 5 for a used car. Well, 6 or 7 years ago, that was 6 or 7%. That same used car, that same loan today is going to cost them 9 or 10%. That's a big jump. If you're a corporation that 5 years ago, you rolled over all your debt, your good credit, you rolled over all your debt, at LIBOR plus 3, so you're paying 5%, and you termed it out. Now you've got some debt coming due next year. Well, you're going from 5% to 8 or 9%.
Our household was a little microcosm of this, and I'll give this test. I haven't told anybody this on our channel. When my wife and I sold our home during during the COVID crisis period and all that, we thought, we got out from underneath this. We don't have any debt now. That's good. We washed our hands of this mortgage. Now we're just in cash, and we're renting back from the investor who bought the home from us. And it was a significant higher rate than what we had been paying on our mortgage, but we thought, well, it gives us the flexibility and we have the liquidity now, so that met our needs. Now we're flexible, we can move, because we were planning on relocating. A year later, he said, sorry to tell you this, but and by the way, he was a cash buyer, so he came in, we closed in cash, all that sort of thing. A year later, he says, I'm going to have to raise your rent by about 50% because my financing costs on the home, my commercial loan that I have out from the bank on your home has gone up that much. And we thought, wait a minute, he's a cash buyer. Little did I know at the time that cash buyers don't keep their cash in the home. They right away extract it back out and take out a commercial loan to cover it. And so he must have taken out a variable rate loan. Little did we know.
Right.
And so we turned around, and pretty soon we thought, we can't keep doing this.
Sure.
We can't keep paying. Now we're paying 3 times as much as what it cost to own the home ourselves.
Right.
So it's that impact on him as a small business owner also impacts all of his customers who are stuck with the higher prices that the business has to charge when these corporate loans, these business loans get refinanced. And some businesses have non-recourse loans. They're walking away from skyscraper office buildings. And how does that affect the banks? Is the stability of the banking system?
Well, a lot of U.S. banks, as you know, are continuing to continue to value these loans at 100%. They're continuing to value these loans at cost until the person turns back the keys and they don't have a choice. There is no choice but extend and pretend, or pretend and extend, whichever one it is very, very real. There are loans, a lot of these commercial real estate loans are syndicated, obviously. So they're syndicated both to a group of U.S. investors, but also internationally. And there are exactly identical loans on the same building where the Japanese bank has had to write it off completely because their regulators look at it and they have to write it off. The German banks have written it off, but the US bank on the same loan still is carrying it at par. And they will carry it at par as long as they can because, that helps them. There's a lot of what's the word, I guess? A lot of illusionary.
Sounds like overhang.
factors.
Yeah.
Yeah.
And so you mentioned in the market leaders and laggers, breadth is horrible. It's maybe one of the worst markets in history for that.
For at least 20 years and
so
probably more.
A lot of our viewers are late career stage and retirement stage. They are counting on their pension plans. They're counting on their on their 401ks and on their brokerage portfolios to be a major, if not the major portion of their survival income in retirement. And yet they are looking at the headline number of the market, and it's like looking at the surface of a bubble or something, because the market breadth isn't under there to support that. Is it possible, probable, realistic in your view that there will maybe be a significant market setback in the near term?
I suspect, and this may be wishful thinking, but I suspect that in the near term, what we're going to see is a rollover. So we're going to see the market leaders roll over, but the money still continue to go into some of the laggers. The laggers, not just gold and silver stocks, of course, but the laggers would be small cap value, for example, or value in general, which has lagged, but particularly small cap value that has lagged. We're going to see money go into the foreign markets, which have lagged, particularly the smaller foreign markets, which have lagged dramatically. So I suspect that because there is still so much money floating around, you and I may not have it, but there's so much money floating around, but that money is going to just roll over into other sectors. I'm not looking for a market crash, but I could be wrong now. And you talk about 401ks, the dangerous thing. I mean, I get this all the time. Every year, maybe a dozen or 15 of my clients will say to me, "Hey, you're not managing my 401, but do you mind looking at it?" They'll send me, every year the firm says, "Well, these are your choices for the upcoming year." And they'll say to me, "What should I pick?" And when you look at those choices, not necessarily for really large firms, but for the smaller firms, their choices are U.S. big cap, U.S. small cap, bonds or cash. Those are the choices. They can't go into emerging markets. They can't go into resources. They can't go into gold and silver. And so they just say, well, okay, keep on rolling it over. And so more and more money in more and more money, we know this, more and more money in 401ks just keeps pouring in to the same stocks. So it's a self-reinforced mechanism. It's a self-reinforced mechanism until it stops. And the danger is, of course, that people with 401ks, a lot of them don't really know what they're investing in. They don't know that 50 or 40% of their portfolio is NVIDIA. And if you said, "Do you want to be in NVIDIA?" I'm not saying anything about NVIDIA. It could be the greatest company, in the history of the world. But most people don't realize that, 40% of their retirement savings are in, 1, 2, 3 stocks. And that's a very dangerous situation.
Right. They think they're broadly diversified. Yeah. Can you talk to us about the illusion of diversification that people have? That's one example of it. I hadn't thought of that most recently. Is this, you think, I'm invested in the Dow, that's 30 companies. Yeah, or the S&P 500 or whatever. But if that's so concentrated, you're not really diversified as you think you are. But what about diversification in general between stocks, bonds, real estates? In the sense, we've heard many analysts talk about the bubble of everything over this depressed interest rate environment over the past 4 decades has led to where you can't really use those as effective hedges against each other necessarily.
Right.
Is that your view?
Absolutely. If everything's in a bubble, you're not getting any diversification, but diversifying into multiple bubbles, because when one pops, they'll probably all pop. And it is absolutely, at root cause is the fact that we've had excessively easy and irresponsible, frankly, excessively easy monetary policy for essentially 40 years, since Alan Greenspan bailed out long-term capital back in the late 80s. And it only got worse after the great financial crisis in 2008. It only got worse. And of course, it got extremely worse at COVID. But it's really been 40 years or 30, 35 years anyway of just irresponsible monetary policy. And for the last 12 years, interest rates that were lower than they should have been. And so that encouraged people to borrow money. It encourages malinvestment, and it encourages, it creates the bubbles that you're talking about.
The demand that you described from China and India and elsewhere for physical precious metals, is that, in your view, an effective hedge against these bubbles, the stocks, bonds, and real estate bubbles that we've been in?
You mean is physical gold a hedge?
Yes.
Yeah, absolutely. Right now, I can't think of anything else I'm not saying you should put 100% of your assets into physical gold. Some of it should be in gold stocks, but that's a joke. But yeah, I can't think of anything else that is truly a hedge on bubbles. Cash, if it's in a strong currency, and gold. I mean, physical gold and silver. That's really the only hedge there is against bubbles.
For people who have friends, neighbors, family members, coworkers who poo-poo whenever they use the gold word or whatever, whenever they talk about this, because they say, look, my personal financial planner has been keeping me in good shape for the last 35 years. I'm sure he says, just see, it's always proven true for the last 35 years. You buy in the dips, you hold, you keep contributing, it'll all turn out. How can they communicate to their people they care about that they're afraid are in harm's way if they just continue to do more of what they've done?
No, that's an excellent question, because everybody looks at, recent experience, obviously. And, anything beyond 35 years, you think is just history.
Ancient history.
Doesn't apply anymore. I mean, so I'm really interested in history. So, I mean, one thing I use that is effective with some people, but not with everyone, is, look at 1966 peak. And from 1966 to 1982, the stock market went nowhere. That's a long period of time for you to be sitting going nowhere. You don't even have to go back to 1929, but you can if you want to. 1929, it was 1947 before we exceeded that high. That's a long time, to be waiting. But certainly 66, a lot of people can vaguely relate to, Beatles and Rolling Stones.
And my 1966 Plymouth Barracuda, the Formula S that I restored. Yes.
And England winning the World Cup, let's not forget. So 66 was a good year in many ways. Not for the stock market, though. The point about 66 is, and this is important, the market didn't crash. Right? Everybody thinks of stock markets going down. They think of a crash, and people think, oh, the stock market's not going to crash. And of course, we never know it's going to crash until it happens. Nobody sits around, in August of 1987 saying, I think the market could go down 50% in a day. Nobody sits around saying that, I don't think. But you can have a situation where the market just doesn't go up. And again, that can be, if you're in the market for 16 years and it doesn't go anywhere, you are effectively going backwards.
Especially in a regime of runaway degradation of the currency.
Of course, you had the 70s where part of that period was the 70s, where you were losing money dramatically. So, that's one thing. I think the other thing is to ask people, well, what exactly are you investing in? You've got this great 401k, but your financial planner has helped you out with. But do you know what you're invested in? Well, it's worth finding out. What are you invested in? Oh, I'm in, an SEP, lookalike fund. Okay, so do you know what stocks are leading the S&P? Just try to get people to answer the questions, I think, is important.
Fair enough.
But yeah, you're right.
So this is how you can open conversations with people that you care about, because a lot of our subscribers are what they call the black sheep in their family. They're the ones who have believed that we're not being told what we need to be told in order to position ourselves to survive and thrive going forward, and to not take on and not maintain unnecessary risk in increasingly risky times.
Right.
But so this is a good thing to just...
And then you start talking about gold and people think you're a nut. I know.
Yeah. Well, ironically, our grandparents and before, they understood that was money. And frankly, globally, in India, in China, they still understand it's money.
That's right. But the problem, again, is always, well, that's China and India. They're backward with the United States. And, oh, no, not the Weimar Republic again. That's 100 years ago. But, the plain fact is gold has served people. For gold to serve people, as you know, this is the essence of gold. It has protected people's wealth in many countries in many times throughout history. And it will do so again.
Well, Adrian, it's going to be fascinating to hear your talk at the conference. And for those of you who have not yet registered for the conference, which is now in its third day of 4, you can still get access to the virtual conference, which will be accessible for the rest of the year, so you won't miss anything if you do that quickly. And you'll find that in the description of this video. And Adrian Day, if people want to find out more of your writing and your work, where should they get connected?
Yeah, the website is adrianday.com.
That's easy.
That's easy.
Well, thank you for joining us again on Liberty and Finance.
Well, thank you very much, and say hello to your son, please.
Will do.
Yeah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for July 8th through July 15th, 2024, while supplies last. First, we featured 2024 American Silver Eagles at just $5.95 over spot. Next, we have backdated gold 1/10 ounce Eagles at $39 over melt per coin. And finally, we're offering Dealer's Choice Constitutional Silver half dollars at $2.50 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.